You're listening to the Cash Podcast, creating affluence, success, and happiness with your financial surgeon, Adam Koós, President and Portfolio Manager at Libertas Wealth Management Group at libertaswealth.com.
All right, happy Friday as always, everyone. With interest rates starting to bounce a tad bit higher, we're going to talk about whether or not you should consider refinancing your mortgage today, whether it's your home, whether it's a farm, whatever property you own, commercial, residential. But before we get started, as always, we have some housekeeping items we want to go over. So first of all, if this is your first time listening or watching, then thank you so much for joining us. The Cash Podcast is produced weekly, and as stated in the intro, Cash stands for creating affluence, success, and happiness, and that's our mission. My hope is for you to learn a little bit more on each and every episode so that you become more successful, wealthier, happier, and more educated than you were when you started listening today. So please come back often. Feel free to subscribe on iTunes and YouTube. In addition, you can also follow me on Twitter at Adam Koós and on Instagram at Financial Surgeon. And last but not least, you can always keep in mind, please, that all visuals, charts, any other educational resources we might show in any episode, although we're not going to have a whole lot of visuals today, they're always available on our website as well as PowerPoint slides. So let's go ahead and get started here. Today, like I said, we're going to talk about whether or not you should refinance your mortgage. And this is kind of a hot topic right now because interest rates fell to record lows. We're seeing kind of a little bit of a jump or a bounce in interest rates lately, which I think is creating some anxiety for those people who are either looking to buy a house or looking to refinance their current mortgage. Now, I would have never thought in a million years that if you would have told me 3 years ago that interest rates would be, at 2.875%, which is where I'm at in terms of trying to refinance my personal mortgage right now, but I would have laughed at you. So every year, every 2 years, 3 years, we keep saying when interest rates hit a low that they can't get any lower. And here we are again with interest rates at or near, I should say, record lows. So the big question, of course, comes when it comes to refinancing your mortgage is whether or not it makes financial sense or not. So let's talk first of all about some math, and then second of all, I'm going to answer some frequently asked questions. So first, let's talk about a break-even analysis, and I'm going to keep this super simple. So for those of you on iTunes, this math, I'm going to have these slides on our website if you want to look it up later. Just go to libertaswealth.com, click on the education tab, go down to podcasts, and click on this episode, and you'll see these PowerPoint slides. So, but I'll talk you through it anyway. So here's what we're looking at. We're looking at the break-even math for refinancing a mortgage. So let's just say, hypothetically, to keep numbers simple here, you have a $1,500 per month mortgage. So if your mortgage is $1,500 a month, and you're looking to do refinance, and you talk to a mortgage advisor, and they tell you the new payment is going to be $1,300 a month. Pretty easy math, right? So $1,500 per month was your old mortgage, $1,300 is the new mortgage. We do the math, we subtract $1,300 from $1,500, and what we have here is a $200 per month savings. Now, of course, the thing you always have to keep in mind is what's it going to cost me to refinance? Obviously, the interest rate's lower. You might even be extending your mortgage out into the future. Let's just say you only have, 12 years left on your mortgage, and then if you refinance it to a 30-year, of course, you're extending that mortgage out 30 years, not 12. So that has to be kept in mind as well. But when we look at the break-even here, we're getting a lower interest rate, and it's going to save us $200 a month. So what's going to cost? Well, in this case, in this example, I said the closing costs are $2,400. Again, I'm just trying to keep things simple. So if the closing costs are $2,400 one time to refinance your mortgage, then the break-even is very simple. It's just $2,400, the cost of the closing costs, divided by your savings, which is $200 per month, the difference between your old $1,500 mortgage and the new $1,300 mortgage. And if you divide that in $200 into $2,400, the closing cost, what that gives you is a 12-month break even. So what you could basically assess is that by refinancing my mortgage and paying the $2,400 to refinance, then I break even 1 year from now, and therefore, as long as I stay in the house for at least 1 year, I've broken even, and it makes sense to do so. So that's kind of the math that you want to look at. Now, there's some other frequently asked questions here that I hear a lot in my work as a financial advisor, and let's just kind of go through some of these questions and answer them, and there's just 3 here. The first question is, I have only 12 years left on my mortgage. Does it really make more sense to refinance it, or does it make sense to just keep paying the higher interest and pay it off in the next 12 years? So should I pay the higher interest and pay it off, or should I refinance, understanding I might be extending my mortgage out 15 years or to a 30-year mortgage? And here's the answer to that question. So if you're going to live in your house forever, then I think it makes a lot of sense to potentially pay off your mortgage. Now, you also have to keep in mind the cost of interest rates. So if you're paying, say, a 3% interest rate or even a 4% interest rate, in many cases, that's tax deductible to you. So if you're in let's just use easy math. If you're in a 4% interest rate on your mortgage and you're in a 25% tax bracket, then your after-tax cost of your mortgage is actually only 3%. How'd I come up with that math? Well, it's real simple. So 25% of 4% is 1%. 4% minus 1% is 3%. So your net after-tax cost of your mortgage for a 4% mortgage is actually only 3%. So the question you then have to ask yourself is, do I think I can make more money? Do I think I can get a higher rate of return elsewhere, whether that's in my 401k, a Roth IRA, my traditional IRA, my brokerage accounts, in the investment world, let's just say, can I get a better rate of return than the cost of the 3% mortgage? Now, in most people's cases, they're probably going to say yes. Now, if you're a super, super ultra conservative investor and you're buying CDs and money markets and you're staying away from anything that has any sort of risk, then chances are you're probably looking at somewhere in the ballpark of a 1 to 3% rate of return on your investments anyway. So maybe it does make more sense to pay it off or to make extra payments, let's just say. But if you're not going to live in that home forever, and if it's not your forever home, you're not going to, let's just say you're going to move to a new home, maybe downsize, let's just say, or perhaps move to a new state at some point in the future, then it really doesn't make a whole lot of sense to aggressively pay down your mortgage unless you think that that house that you own, your primary home, is an incredible investment in an incredible location with very high growth prospects, and that when it comes time to sell it, that you know for sure, or at least you're very confident, you're going to be able to turn around and sell that thing pretty quickly. Because remember, a house is an extremely illiquid investment. It's very dependent upon the economy and how strong the economy is. And if the market's doing well, when I say the market, I mean the real estate market, if it's doing extremely well, then yeah, okay, maybe you can turn that house around, sell it for a profit. And again, as long as you're in a good area that has a high growth rate for real estate, then perhaps you can turn it around and sell it for a lot more money. But just keep in mind that if it's not a good economy, if it's not a good location, or say it's an average location, and let's just say we're just in a point in our, call it financial lives, where there's just not a lot of people buying homes, all that time that you spent taking good money and paying down a mortgage is going to basically invest in a home that perhaps you might not be able to sell. Or if you can sell it, maybe you have to sell it for less than you thought you would. So you could actually end up losing some of that extra payment that you were putting into it each month or each year because it just didn't work out based on the current state of the economy, let's just say. So I think the answer here, I mean, there's a lot of financial answers, but I think the answer is it depends. Now, if you're going to stay in the house forever, then maybe it does make sense because it doesn't really matter, right? You're trying to get rid of debt. We don't want to have a mortgage. We only want to pay our insurance, our home insurance, and our property tax, and we own our house outright. That's great. So the second question here is, should I refinance to a 15-year mortgage instead of the 30-year because I noticed that the rates are better? Now, normally interest rates on 15-year mortgages, shorter mortgages, are going to be lower because the mortgage company is taking less risk. The bank's taking less risk. If you pay that off faster, there's less risk. Of course, it's an incentive to give you a lower rate. The problem I have with 15-year mortgages, especially for people who are currently working. Now, if you're retired, ideally you don't have a mortgage at all. But if you are retired and you have a mortgage and you have the cash flow to pay it off, then 15 years, as long as you have the cash flow for through your Social Security, maybe a pension or two, and then, of course, withdrawals from your investments, maybe it makes sense to do a 15-year, or perhaps it makes sense to pay it off. But I'm kind of going off the reservation here, but if somebody's saying, well, should I pay off a mortgage that costs me 2.5% and it's tax deductible, unless you're if you're not itemizing, of course, it's not tax deductible. But if it is tax deductible or not, it's 2.5% gross regardless. Then you might say, well, why in the world would I want to take good cash that's earning good money in an investment portfolio, even if it's conservative or balanced, let's just say, to pay off a mortgage that costs 2.5% per year? And that would be a really, really good question that I might have a hard time answering because that's a good financial point. But for somebody who's still working, who has maybe 5 years, 10 years, 15 years till retirement, and they're looking at refinancing, and they have a choice between a 30-year that's giving them a rate of, say, 3%, or a 15-year that's giving them a rate of, say, 2.7%. I would tend to shy away from the 15-year, and this is why. Let's just hypothetically say, if you were to take the 15-year mortgage, you are going to be locked into probably a slightly higher payment because you're going to have to pay more principal. And let's just say, hypothetically, things just got really bad in the economy, and let's just say you lost your job. If you lose your job, now you're stuck being forced to pay this higher dollar amount in this 15-year mortgage, and you don't have a choice. You can't change it. And it's not like you can refinance at that time because, of course, in order to refinance a mortgage, you're going to have to show income, and if you're unemployed, you don't have income. So I think the smarter thing to do, if you're a more conservative person, is to instead take the higher rate and refinance to the 30-year mortgage. And if you're going to stay in the home for a long, long, long time, or potentially forever, make the extra payments. And by making an extra payment or two per year, you can actually mathematically turn your 30-year mortgage into a 15-year. So let's just say you lose your job, though, and you have a 30-year mortgage. Now what happens is you've got this B plan in place where, because you're paying a 30-year mortgage, and maybe you were making extra payments before, but now it's a 30-year mortgage, not a 15-year mortgage, your payment's lower. So now from a cash flow standpoint, maybe it's a little bit easier for you to make those payments as opposed to making the higher 15-year mortgage payment. So that's my thought there. And then the last question here is, should I make extra payments on my home in order to speed up the rate at which it's paid off? And I know I kind of answered that a little bit earlier with the first question, which, again, the first question was, does it make more sense to just keep paying the higher interest on my current mortgage and pay it off versus refinancing and starting the clock all over when I only have 12 years left on my mortgage? So we already kind of answered that question, I think. But this question is specifically related to extra payments. And I hear this all the time. Should I make extra payments on my home, on my mortgage, in order to speed up the rate at which it's paid off? And this kind of ties in with the last question of should I do a 15-year or a 30-year? If you're going to make extra payments on your mortgage, I think the first thing is you have, well, I shouldn't say you have to, but in my opinion, you should probably plan on that it should be your forever home. Again, unless you think that your house is such a great investment that by making extra payment on principal, this is creating more equity in your home, which you expect to grow at a very high rate of return, then I question whether or not that makes sense. That's the first thing. The second thing is, even if it's not your forever home, and we go back to the discussion about losing our job, let's just say there's two people, and it's you and your neighbor, and you both own, just to keep numbers simple again, we're going to say you both own a $250,000 house. Their neighbor has a $250,000 house with a mortgage of $220,000. So they only have $30,000 of equity. Again, $250,000 house, $220,000 mortgage, $30,000 of equity. Let's just say you have a $250,000 house that's exactly like your neighbor's, except your mortgage is only $150,000 because you've been making extra payments, you've been responsible, you've been trying to pay it down and decrease your debt, improve your balance sheet, increase your net worth, which all sound like wonderful things. But now let's change the game here, and let's just say that both you and your neighbor get laid off. And let's just say you come home one day and you pull in your driveway and you just lost your job. You've got your box of stuff from your office, and your neighbor's sitting outside in his driveway or her driveway, and she says, "Hey, what's going on? You don't look like you're in a good mood." And you say, "Well, I just lost my job," and she goes, "I actually just lost my job too." And you think, and you start talking about how you lost your jobs, and you completely obviously don't think about your mortgage because that's not what's top of mind right now. But fast forward 2, 3, 4 months, if you can't find another job and all of a sudden you can't afford your mortgage payments, and the bank is deciding between foreclosing on your property or your neighbor's property, the question I'm asking you, hypothetically, is which mortgage or which home, yours or your neighbor's, is the bank going to be more likely to foreclose on? And think about it for a second. So remember, your neighbor has a house that's identical to yours. It's worth $250,000, and their mortgage is $220,000. Your house is also worth $220,000, but you have a mortgage that's only $150,000. If you both can't afford to make payments anymore, if you both stop making payments and you go into foreclosure, then the first house that's going to be foreclosed is going to be yours, not your neighbor's. And this is why. There is more liability on your neighbor's mortgage because the bank might not know if they can sell it for more than the equity that's in it net after cost. Whereas your mortgage, you've got a $250,000 house with a $150,000 mortgage, they can foreclose on you right now, turn around, sell that house, and they've got a $100,000 cushion in there where they could sell it for $200,000, they could sell it for $190,000, and they would still make out in the end. So this is why I think it's so important to really kind of think about these different things before you make a decision to A, refinance and determine whether it's a good idea for you, B, whether you should do a 30-year or a 15-year, and then C, whether you should make extra payments or not. So just in summary here today, let's summarize our discussion. First and foremost, if you consider a refinance, which I really would consider refinancing right now, I'd at least look into it. If you'd like a referral, an introduction to a great mortgage advisor, I have a couple people that I like, trust, and that do a wonderful job with really, really low closing costs. So please reach out to me if you'd like an introduction. But consider a refinance as long as you'll live in the house longer than the break even. That's the first rule. The second one is, unless you're 110% secure in your financial position, stick to a 30-year mortgage so that you can have a B plan in the case that the worst were to occur and you were to lose your job, let's just say. Third, pay extra and turn your 30-year mortgage into a 15-year or shorter mortgage if it's your forever home. That makes a lot of financial sense. And then last but not least, always remember, the financial industry doesn't always reward those who are responsible. So just because you're doing the responsible thing, you're being a good saver, you're paying down your debt, and you have a lower mortgage, higher equity, and you're a more responsible person, doesn't mean it's going to work out for you in the end, especially if you lose your job, because like I mentioned earlier, chances are if you and your neighbor both lose your job and you both stop making your mortgage payments, the bank is going to want to take the property that has the higher equity in it so they can turn around and sell it for more. So that's it for today's show. Please feel free to share this episode with your friends and family. And if you'd like to discuss your personal situation further, remember, you never have to be a client to ask a question. If you'd like to set up an introduction call or Zoom meeting, just head over to our website at libertaswealth.com to schedule something in our calendar. As I always say, there are thousands of podcasts out there, and you chose to give ours a listen today, so thank you so much for tuning in. Be sure to subscribe on iTunes and YouTube, and remember, you can sign up at libertaswealth.com to get these updates, as well as other screencasts, videos, and articles delivered directly to your email inbox. Feel free to follow us on Facebook. I'm also on Twitter at Adam Koos, as well as Instagram at Financial Surgeon. So again, thank you so much for joining us, and we'll see you next time.
Thank you for listening to the Cash Podcast with your financial surgeon, Adam Koos. To see any charts or images that were mentioned in this show, or to check out additional articles, videos, and other educational resources, head over to libertaswealth.com.